Thanks for having me, and thank you to everyone who's watching. My name is Tom O'Hara. I'm the co-manager of the Henderson European Focus Trust, or HEFT, as I'll refer to it from here, so that it's not too much of a mouthful. I'll spend the next 10 to 15 minutes talking about some of the things that are on our minds, some of the notable investments that we have in the fund, so that hopefully you get a decent idea of what we're about, how we like to invest, and hopefully why Europe as a region is worth considering for investment. So what is HEFT? Well, we're style agnostic, so we're not a growth fund, nor are we a value fund. We don't fall in love with anything, we don't hate anything, and HEFT is run with a philosophy that things change. You know, whether that's in markets, in sectors, in companies, in management teams, and we think that you need pragmatism to be able to navigate that change. We think when you get religion as a fund manager, you know, whether that's in an investment style, whether it's in a sector or a company, or you fall in love with a management team, that can lead to dangerous territory. So we like to invest pragmatically, and we like to invest in change. And now a constant debate in the market, and always a chart that's shown in every fund management presentation is growth versus value. So we'll get that one out of the way first. Hopefully you can see this chart. It's looking more extreme than ever, actually. It shows that the disconnect in valuation between growth stocks and value stocks is extremely elevated, you know, the highest it's been in decades. And in a sense, that's been the story for the last 10 years. Growth has constantly outperformed value in terms of market styles. And there are many reasons for that. You know, lower and lower interest rates, a lack of inflation, growth being harder to come by in a slow growth world, all of those things. But it does look extreme. And that's something that we think about a lot, because we are a style agnostic fund. We have to be ready and willing to tilt based on our view of where the market may be heading. And the questions that we constantly debate are, will value make a comeback ever? Is inflation going to come back? If it does, is it going to be transitory? And you know, it's fair to say that it's been a challenging few years for anything that's not full-on growth. And actually, it's been a really tough 5 months, since about March, April, for anyone not out-and-out growth. So for a value-conscious fund like us, it has demanded, you know, that pragmatism. And I'd just like to clarify that I said value conscious and not value led. So the question we're constantly asking ourselves is, well, what can change? And I think it's worth making an observation on this chart. If you look at the x-axis, it's basically 15 years. It's not really very long in the grand scheme of things. It's less than a generation, but it's longer than a lot of investing careers. And that's quite key, because a lot of people, particularly in my age bracket, that sort of 30 to 40 age bracket, I'm nudging towards the upper end of that bracket for full transparency. But if you're in that bracket, you've never really experienced a market paradigm in which growth doesn't dominate. So if you've never seen anything else, then mentally it's quite a tough thing to challenge. And on top of that, there's a career risk aspect. You know, most of the fund managers leaving the industry are value managers, because they've either gotten fed up and thrown in the towel, or they've been fired. Quite a lot of being fired. And so why risk it? Why not just stick with what everybody's comfortable with and pursue growth? Well, I think we have to remember that some things, some major changes take longer than a generation to manifest. And so we've got to be really careful not just to extrapolate our own sort of narrow time-limited view out into perpetuity and assume, you know, it just continues forever. And one of the things that we always remark upon is how dry the market debate can become. It's all about factors, it's all about what the central bank's saying, it's all about yield curves. It actually becomes very detached from the real world around us, from the experiences of people in society and their choices, you know, whether they're consumer choices, whether they're life choices, investment choices, or political choices. And so when we're asking ourselves what can change, we're really thinking more about what's going to change in the world around us, you know, beyond the narrow confines of central bank speak. And there's one multi-generational parameter that occupies our thoughts quite a lot at the moment, and it's especially relevant to Europe because Europe as a market is quite heavy on global industrials, you know, things that have done really well out of globalization. And what we sense is that there's creeping deglobalization right now. Globalization has been a given, you know, for the last 25, 30 years, but something's shifting. Now, at this point, what I usually do is share a clip on YouTube, but I'm not sure the tech's going to support it today, so I'm not going to risk it. I'm just going to tell you about it. There's a really good interview on YouTube between, it's a US chat show called Charlie Rose, and this episode's from November 1994, and the main guest is Sir James Goldsmith, and on the other side of the debate is Bill Clinton's chief economic advisor. And what they're discussing is the Uruguay round of the General Agreement on Trade and Tariffs. It's effectively the round of negotiations on global free trade that led to the World Trade Organization in its current form. And it's quite odd because many of you will remember James Goldsmith as the kind of archetypal uber capitalist, the philanderer, the corporate raider, the Machiavellian, you know, all of those things. He's actually arguing against the opening up of free trade. And what he says in this clip, far more eloquently than I'm about to, is capital can travel freely across the globe. Technology can be transferred freely and instantaneously across the globe. So the one point of differentiation is the cost of labor. And at that time, he points out that the cost of labor in many of these countries coming into the free trade area is 2% of the equivalent job in Western Europe, in the US. And so his argument is this is going to decimate the middle classes in North America, in Europe, in the advanced economies. And he says this is dangerous. You know, the fallout from this will be felt enormously, you know, in the generations to come. And you know, you fast forward 27 years or whatever it is since then, I think 27, and we do sense a bit of a backlash. And this article I've included here in the slide sums up the backlash in the US quite nicely. You know, it's taken, yeah, the best part of 25 years and the Black Swan event in COVID, but not everybody's happy with globalization, and voters, for example, are making that known. So we don't think it's something from a market perspective that can just be dismissed as political noise, because it's coming from the ground up, so to speak. So what does this actually mean for investment purposes? Well, deglobalization on a basic level means less reliance on cheap labor, less reliance on all of the cheap input costs that go into the things that you and I own. So it means paying more for those things, which means inflation. And then in terms of, you know, other changes that may come on top of that, well, you add in that the energy transition is very high up on the political agenda right now. It's going to require enormous amounts of capital investment into infrastructure. And that's real people building real things. You know, the age of fiscal austerity that we've had over the last 10 to 12 years is effectively gone, for now at least. And again, that means more chance of inflation. And then if you want to be a little bit skeptical and cynical like me, you could argue that the issues being exaggerated by, you know, in investment markets, what we call ESG, which in its current form is, I think, quite dumb and potentially very, very dangerous, in that it could lead to a misallocation of capital and an underinvestment in essential capacities, you know, things like oil, gas, raw materials. You know, that's very topical, and I'll come on to that later. You know, the energy prices, oil, gas, shortage of petrol for those of us here in the UK. But again, what does that mean? Well, a misallocation of capital can mean more chance of inflation. So you put all of those things together, and there's a reasonable argument to say the Fed, the European Central Bank, they're all basically talking nonsense when they say inflation's transitory, because there are a lot of structural reasons to say inflation is going to come back and it's not just going to be transitory. Given the market's not positioned for that, we think that's a really important thing to bear in mind. You cannot just dismiss it, because if you're on the wrong side of the boat when the wind turns, then you're in trouble. So slide 3 is some stocks, and I've included these logos because I think they give a pretty good sense of the spread of exposures that we will go for in the fund. And you know, if I go through them, we see value, we see change in a cement company, Holcim. We see value and change in a steel company, ArcelorMittal. We see value and technological advancement in Signify. Now, Signify is the old Philips light bulbs business. Incredibly cheap, because people think that light bulbs are a commoditized and not very high growth industry. But we think actually Signify has a number of technological solutions for the challenges of tomorrow, and notably the energy transition and the need to grow food sustainably in smart greenhouses and vertical farms. So that's change going on within a company. It's taken a number of years, but it's really coming through now. And then finally there, we've got Acast, which is a small Swedish listed podcast hosting technology company with top line growth at about 60% per annum. So that's in there just to tell you that we're not completely growth phobic. We will do it, but as I said, we're pragmatic. You know, we go for growth where we believe in it and where the valuation stacks up. But given the situation that we're seeing on the news, oil up to $80 a barrel today, gas at multi-year highs, energy prices rocketing, I thought it'd be also worth mentioning to you that we are invested in big oil, which, you know, you're not meant to say that necessarily these days. It's not a very fashionable sector to be invested in, but we've been overweight oil in our trust since last year, and we continue to be. And you know, being honest, it's been painful at times, because even as the oil price was going up, the stocks weren't going up. Nobody wanted them because the market only cared about growth. Now, why do we have big oil, or why did we invest back then, and why do we stick with it now? You'll have to excuse me for a moment while I just pause to let my screaming son move from the bathroom, he doesn't like that time, to the bedroom. So there we go. I can hear the fade of the price, so we'll carry on. So why do we own big oil? Well, we were positive on the recovery out of COVID, the reopening. We're positive on the medium-term supply-demand balance. Demand is still going to grow, you know, like it or not. And supply is actually struggling, because these companies, particularly the Western listed big oil companies, they've been branded as sinners for carrying out the activities that they've always carried out. And so they stopped doing it. They stopped investing in upstream oil and gas capacity. And lo and behold, oil today hits $80. And gas, as I said, is at multi-year highs. And we're all feeling that now in our wallets. In terms of the stock market disconnect that we see there, what are we seeing in the real world versus what we're seeing in the share price as well? How about this? The oil price is now up 60% this year. The big oil stocks on average are only up 18%. And actually about half of that 18% gain is just from the last 5 trading sessions, as the market started to panic, and presumably a lot of investors have gone, oh, we should probably have some exposure here. But still, they have not performed in line with the underlying driver of their revenue. Now, the big sort of final reason why we feel comfortable investing in big oil is because the companies that we're invested in across our funds, and in HEFT, it's Total Energies, it's Lundin Petroleum. Why do we believe that they are worthy of investment beyond just the oil price? Well, they're all demonstrating a very, very high level of capital discipline. And this actually reminds me of the mining sector when they all had near-death experiences in late 2015, early 2016. They came out of that and they really tightened their belts. And actually it coincided with a very good period for commodity pricing. So they had a wonderful period of paying off all their debt and then having lots and lots of cash to give back to shareholders. And that is exactly what's happening now in the oil sector. Management teams are not spending money on silly things. They've promised that they're going to give it back to investors in their shares. And right now you've got big oil stocks trading on 20% free cash flow yields, which is kind of insane. And obviously there's an argument that, well, they're going to go out of business, in 20 years time, or they're in runoff. You only invest in equities because you see a future for them, and if you don't see a future for oil and you can't really time it, then what's the point? But let's say a stock is priced at 10 quid, and that management team basically guarantees you that each year you will get 2 quid of that back. Then even if there is a debate to be had about whether these oil companies exist or look totally different, say once my children are grown up, it's not something that I have to necessarily be concerned about right now when I'm getting £2 every year, having paid £10. So that's the way we're looking at it. It can sound a little bit old-fashioned, it sounds a bit deep value, and that's not something that most fund managers would want to admit to these days. But we think the disconnect is so great that we have to be there. It's a real sense of conviction on that. So that's big oil. I've just come on to the final slide. I'm going to wrap things up here. This is a little bit of detail about our trust. One thing I didn't mention was that we have a maximum number of holdings of 45 stocks. So we try to be concentrated and high conviction in how we invest. And then finally, you'll see there 2 mugshots. On the left is John Bennett. He's the lead manager of the trust. I think he's now in his 34th year of investing. And then there's me with a slightly different haircut. And with that, I will hand it over for questions. Thanks very much for your time.
Tom, thank you very much indeed. Okay, kicking us off, first question is about the investable universe. Is there a size limit? How small companies you'd come down to? What's the limits or top and bottom?
Yeah. So it's a really good question, and generally the way we think about it is we'll have a minimum 1% position size in the trust because we're concentrated. We're 45 stocks. That means that if you look at the NAV on the slide there, it's a little bit higher than that at the moment, but it means to have 1% in a stock, you need to be able to buy about 3.6, 3.7 million pounds worth of stock in order to have that minimum 1% position. So then we have to think about liquidity. And we don't particularly like having too many stocks that would be difficult to get into and difficult to get out of, let's say over days and days, weeks and weeks. So actually a lot of our holdings are anything from European large cap down to the low end of mid cap, let's say 2 to 3 billion euros market cap at the lower end. But we do have exceptions because it's a trust, and this is the beautiful thing about HEFT. It's closed capital, it's patient capital. You're not suddenly going to get a redemption notice that means you have to suddenly sell stocks that might take days to get out of. So we do have selective smaller cap investments, and ACAS, the podcast company there, was one of those. It's about, at the minute, about $600 million market cap. So we will do small cap where we feel high conviction about it, and we just make sure that it's those types of positions certainly don't dominate the portfolio.
Thank you. Next question. The trust from the outside looks pretty similar to the Henderson stablemate Henderson Euro Trust. Could you comment on how the two products differ?
Yes, well, they're actually very different. Euro Trust is much more growthy, managed by Jamie Ross. He's a growth manager on our desk. He likes growth. We are, as I said, more agnostic, a bit more growth skeptical. We're value conscious, and at times that's gone against us, because there have been many periods over recent years where actually you should have ignored valuation and just owned expensive things at 25 times PE plus. But coming back to Euro Trust, if you look at the valuation metrics on Euro Trust, you'll see generally that it's more expensive optically. But the great thing about the European desk in general at Henderson is that we have that spread of investment styles on the European desk, and so we share ideas. So Jamie and his investment philosophy brings a lot to our funds as well. Even if we don't follow him with some investment ideas, some stock ideas, it's a really good challenge to our investment process, and you have that spread of skills across the desk.
Excellent. And it's time for a final question. And again, apologies for those I didn't get a chance to ask. There's been some really good questions here, but we don't really have the time. Does the trust use gearing, and could explain the gearing policy?
Yeah, so generally speaking, we're sparing with gearing. So at the minute we are geared up because actually as I said with big oil, there's a growth value disconnect here. So we've taken gearing up a bit to tilt to that value mispricing that we see. And so we're about 3.5 to 4% geared on the trust at the minute. It's not very high, and generally we'll take gearing anywhere between sort of 0 to 5%. The one exception was March 2020, which obviously was the big market sell-off once everybody realized that COVID was going to show a lot of things down. And we took gearing up to about 9% during that, because we felt things had gone seriously too far. So we felt comfortable doing that. In terms of how that compares to other trusts, well, other trusts being closed capital means that actually there's an opportunity for trusts to deploy gearing on a much more normalized basis. And so we do see some of our peers on the desk that are constantly at sort of 10% gearing. So that can be done. Whereas in contrast, we don't particularly like leverage, and in hindsight, very glad that we weren't geared up into the market sell-off in March 2020, for example. So we'll tend to be more sparing, between 0 and 5%. We're getting towards the upper end of that right now because we think the market is shifting.
Lovely. Well, Tom, thank you very much indeed for joining us this evening.
Pleasure. Thank you very much for having me.